You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. In a turnaround from making multi-year highs, stocks took it on the chin much of this week as investors watched escalating tension and violence in Libya and tried to gauge the potential impact of that on Libya's oil production and ultimately on the U.S. economic recovery. Oil topped $100 a barrel about midweek before settling back under $100 just a bit amid rising violence in that region. Meantime, U.S. economic news came in mixed on the week. And the Commerce Department reported on Friday that the U.S. economy grew at just 2.8% in the fourth quarter, slower than first projected and below forecasts. And we'll be talking about all of that at the roundtable a little bit later on. But right now, Shiraz Mian joins me here, front and center, to share some of his opinions on what we can look forward to here in the days and weeks ahead. Now, some market watchers are already saying, Shiraz, that we're beginning to ask the question, really. Are we at the crossroads of a correction in the market or the beginning of a new bear market? What do you think?
I would subscribe to the view that it's a correction, but I would add to that that it's more temporary in nature than some of the folks are basically calling it. The emergence of this new uncertain variable in the shape of unrest in the Middle East and its impact, as you alluded to, on oil prices and as a result on our economic recovery is a real concern. My personal feeling, having covered oil market for a while, is that most of those fears and concerns are exaggerated. The extent of the oil that is off the market in Libya is very easily offset by excess production capacity in OPEC, and as we saw some reassuring words from the cartel and Saudi Arabia and other agencies, we see some of those fears and concerns easing. So there is a correction. We had run up very nicely from last fall's lows, but for a bear market to take hold, we need the U.S. fundamentals to weaken significantly, and I don't really see that happening anytime soon.
Okay, so if I understand what you're saying, then there is still room for optimism.
There absolutely is. The broad fundamentals of the recovery that we saw in the fourth quarter, and as you mentioned, the growth numbers were revised downwards to some extent, but we still have the makings of good sustainable growth momentum in the economy, which has carried into the first quarter and beyond. So the economic fundamentals look sound, the recovery is firmly in place, and I don't think the oil story has staying power, which means that yes, the outlook for the market looks as good as it was before the emergence of the Middle Eastern problem.
So you think the economic growth is on solid footing here?
It sure is. We have the consumer, the manufacturing side, consumer confidence, and even some tentative evidence of a turnaround in the labor market that we have consistently been seeing in recent days, and that tells me that the growth that we saw in the fourth quarter is accelerating and ramping up in Q1 and Q2. So absolutely, I see the recovery on much solid and sounder footing than folks are giving it credit for.
And all the concern around oil and those gyrations in price as a result of tensions in the Middle East, unwarranted, you think?
They are warranted. But the extent of the fear premium that I was seeing in oil prices over the last few days, in my judgment, was representing a worst-case scenario. And that extent of fear premium was unwarranted. When you have tensions and uncertainty about a region that produces a third of global oil supplies, some concern is completely justified. And my sense is that even as these fears ease today in the coming days, we will continue to have this air of uncertainty hanging over oil prices, and as a result about the broader market in the coming days as well.
How do interest rates play into your optimism here?
Interest rates is a big issue. It's not a huge concern here for us in the U.S., primarily because the inflation numbers are so tame. And also, when you have these global concerns and global issues, they typically result in investors flocking to the U.S. market for safety. And you are seeing evidence of that in the longer yields on Treasury bonds, which have pulled back in recent days in response to the Middle Eastern tension. With respect to interest rates, the Fed has a lot more room, given the tame inflationary picture, to stay on the sidelines, complete the QE2 program that they announced earlier. So the inflation picture and the interest rate picture remains supportive.
All right, we'll see in a little bit. And stick with us, there's more still to come. Here is your Bull and Bear Stock of the Week. A media conglomerate and a food company, two very recognizable names, are this week's Bull and Bear of the Week. Shiraz Mian, our research director, back with us to explain the nuances of each. We'll start with the bull as we normally do. And of course, Disney is the media conglomerate. Everybody knows that name.
That's right.
And as a media company, they've been run pretty well up to now.
Very well run media conglomerate. And they have the type of assets and well-integrated assets with each other that are very well positioned for the upcoming improving outlook for the consumer end of the economy. And we see that across the board in their different businesses, whether it's on the TV side, on the theme parks side, or also on the studio side. So the advertising revenue is looking very good on the TV side, particularly on the cable, specifically on ESPN. In the theme park, which also includes their cruise ships, the bookings are looking up despite the fact that they have increased capacity in there. And on the studio side, they recently articulated that they will be increasing their spend levels on franchise movies from about 40% of the total to about 60 to 70%. And franchise movies are always a better and higher margin lifetime revenue earners for the company. So overall, Disney is looking very good. We are seeing that in estimates. We are seeing that in the company's results. They beat in the recently fourth quarter results as well, and estimates are going up.
And they're looking to expand in the video games arena too.
They're expanding in video games. They are expanding on the theme parks. Shanghai Disney is an upcoming attraction. So it's despite their size and despite their diversity, they keep the market excited about new offerings, and that's behind the Disney being the bull.
All right. Well, people are not too, at least investors are not too excited about Sara Lee Corporation lately. SLE, the ticker symbol, that's the bear of the week. They've been having problems for a while.
They do. In fairness to them, the new management team that came in late 2009 had been doing all the right things, including putting the company on the block.
Or parts of it, anyway.
Or parts of it. But it's been tough for Sara Lee. And the reason I have them as the bear of the week is two. Number one, the run-up in commodity prices, particularly on the food side, wheat, corn, soybean, coffee, and sugar. And these are major input costs for Sara Lee, which is hampering their ability to earn decent margins. They are increasing prices, but it's more than getting offset by the cost inflation. And secondly, the uncertainty related to the future of the company. They are talking about now of splitting up into two companies, one primarily focused on the retail side in the U.S. The other focused on the international beverage side. And there are way too many financial, regulatory, and tax issues in that scenario, which is in my view will keep the stock under pressure for quite a while.
All right, we're going to have to leave it there. We're talking about another stock next. And now, Stock Talk, analysis of stocks in the news. Well, Green Mountain Coffee Roasters said this week that they're entering into a partnership with Dunkin' Donuts, of all companies, whereby it'll make Dunkin' Donuts coffee available in its Keurig single-cup coffee brewers. A Green Mountain stock ticked up just slightly on the news. Our equity strategists Tracy Reinick and Mike Vodka are here now to take a little bit of a closer look at Green Mountain Coffee Roasters on the heels of this news. And the one thing that's puzzling everyone is the rumor had been through the markets that Green Mountain was going to partner up with Starbucks.
Right.
Nothing's been said about that yet.
No.
So, what does this mean for Green Mountain?
The Dunkin' Donuts announcement was a big announcement because Dunkin' Donuts coffee is really popular.
Yeah.
It's something like 4 or 5% of total sales, and that kind of brand of coffee. Green Mountain had its own brand that tasted similar, which was its best-selling brand, but now they're going to get the real thing. So these kind of partnerships are a big deal.
But check this out. Green Mountain trading at last published report I saw, which was just earlier this week, 295 times cash flow, 81 times earnings, and these have been the highest earnings in the company's history. So fundamentally, they're just going higher.
Yeah, it's not what I would consider to be cheap.
Right.
A lot of my colleagues in the Momentum Aggressive cover this company, but I don't as a value person. But it's trading 33 times forward, and estimates are rising. Earnings are expected to grow about 80% this fiscal year and another 40 to 50% next year. So the earnings growth is there, but it is a very expensive stock at these levels.
Mikey, from the momentum side, you got to be loving this picture.
There's actually a lot going on with this chart, just like you said. Yeah, it's fairly interesting. The long-term trend is most definitely bullish, and the short-term trend is bullish too. We saw shares gap higher on strong Q1 results in later February, above the $38 level. That was a key level.
Yep.
So we do have a new 52-week high in tow at 47.81. Shares have pulled back a little bit since then. But then just taking a look at the longer-term picture here, the 5-year chart, this just gives you an indication of how strong this stock has been for the last few years. We saw shares of Green Mountain bottom out in March of 2009 with the overall market. And since then, or actually they bottomed out right about, $5, $7 between that range. And since then, we've hit 47. So Green Mountain has put up some huge gains over the last 2 years, some very strong upward momentum.
Well, 18% just in the month of February alone, as far as gains are concerned. I mean, it's high.
Yeah.
There's nothing more you can say.
You know what else is interesting, though, I should mention, is that, backtracking the chart just a little bit, is that even though shares have rallied a lot, the stochastic, which is an indicator of overbought or oversold conditions, says that shares of Green Mountain are trading in oversold territory, so it could be a long-term buying opportunity.
See, now what I'm reading says that multiples this high are derived from even higher expectations about future growth. So.
Right. I mean, people are pretty hot on this company because they're the main makers of that kind of brewing system here in the U.S., and then they expanded last year into Canada. Right. This kind of brewing system is really popular in Europe. So, and the sales growth here in the U.S. has been, going year over year, the same kind of pace. And that's why Starbucks and Green Mountain, are both kind of eyeing each other because Starbucks is like the bigger partner in the room, and
so
what will they do?
So what if they did enter into a deal with Starbucks as well? This got to propel them even higher.
You would think so, because Starbucks is one of the bigger known name brands, but they're trying to consolidate these other brands under their umbrella, plus their own brands and their own delivery system. And it's a pretty good combination.
All right, we'll have to see how it shakes out. Thank you both. We're back at the round table. Stick around. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Another revision to the fourth quarter GDP, higher oil, and top stock picks of the week. That's what we're talking about here at the Roundtable with our research director Shiraz Mian, top market technician Kevin Matris, and equity strategist Tracy Reinick. So, Kevin, I'm going to start with you.
Okay.
Got another downward revision to the fourth quarter GDP, down to 2.8% below forecasts. How does that set with you?
Well, you know, I mean, it was kind of a disappointment. The first estimate was 3.2.
Yeah.
I think the consensus came in for 3.4. So yeah, we completely backtracked down to 2.8. First off, though, I do want to say 2.8 for Q4 is still a lot better than 2.6 for Q3. So the economy is still growing. It's just not growing as fast as people would have liked. But I do want to point out, if you were to look at the numbers, I think the main culprit for this decrease was lesser local government spending.
Yeah.
So that was unfortunate. But also, too, though, you know, you saw a downward revision in personal consumption. Personal consumption is still very strong, but there was still a slight revision downward. You see this in final sales as well. On a good note, exports were up. But the increase in exports weren't enough to offset the decrease. So we are okay. I don't see anything, you know, terrible happening to the economy, but I believe that everybody's, you know, forecast for 3.4 or even higher, that may have been a little bit too ambitious.
You brought up a good point, because now we do have that new component entered into the mix, government spending, where before we were just concerned about consumer spending and what the consumer was all about. Now we see that slower government spending puts a drag on the economy as well. So, Tracy, what is this all telling you besides the economy's not growing as fast as we want it to?
I wasn't as disappointed as Kevin was in this number, because I did think it would pull back a bit. But as he said, I mean, we're still seeing this. This is a pretty good growth, and we're finishing up earnings seasons now, and this was a great earnings season. The U.S. corporations are doing really well. We do have this government issue, and next week is the looming federal government shutdown possibility, which is a bigger issue than I think is getting play, because Libya is overshadowing what's happening over here. So that problem is not going to go away, but the underlying economy is doing real well right now.
Time for another episode of QE, Shiraz?
I don't think so. One comment I'll make on the fourth quarter GDP number is that the downward revision or the greater than initially estimated revision to government spending, particularly on local and state level, there is evidence that more of the growth is coming from sectors that we want to see in the economy, consumers and other sectors that are more stable. So I think the economic growth momentum is in place, and we don't need more stimulus either from the government or the Fed.
All right, talk to me about oil. Is oil the lifeblood of the U.S. economy? Yes or no?
Yes, it is.
Okay, so then tracking in my mind, higher oil equals higher inflation equals economy not growing so well. What do you say?
I think the broad outline of that equation and transmission mechanism is true. However, there is a however.
Okay.
Number one, the economy, as I mentioned, is in firmer ground than it was, for example, in the past. So we are in a better position to face up to $100 oil or $350 gasoline. Number two, the spike that we saw in oil prices are because of factors that, in my view, are temporary and fleeting. So I don't think oil price is headed further higher. If you have oil prices go to where it was, for example, in mid-2008, then I would be really concerned about the sustainability of the economic growth recovery. But $100 oil will just be a hiccup.
Kevin, does every extra dollar a consumer has to spend on a gallon of gasoline take yet another bite out of the U.S. economy?
Yes, it does. Getting back, how's that for an answer? Let me tell you, I disagree with Shiraz a little bit.
All right.
Last year when we were talking about oil, I think it was at like, I don't know, $70, $75, and we were both predicting oil would hit $100. I said that. I think you were on the same thing. We were both looking for 100. Personally, though, I think that oil is on its way to 110 or 120. It is true that the little blip that we are seeing right now has to do with Libya, and it really shouldn't, because Libya only accounts for 2% of the world production, and only a small fraction of their production is being compromised. However, right now, and the U.S. economy isn't even firing on all cylinders. We have record demand. The last time we saw this much oil demand was never. So we have record demand, and the growth rate for the demand is increasing at a faster pace than we have historically, but supplies are not growing as much. I think there is a lot more to go for oil. I think we're going to 110, 115, maybe even 120.
Tracy, where are you at on this oil, gas, economic recovery issue?
I definitely think it's going to impact if it keeps up at these levels, because it has to. I mean, every time you go to fill up your car, you feel it, and it's starting to be put through on all, every kind of commodity that uses oil, which is basically almost everything.
Yeah.
So you're going to see price increases there. But I agree with Strauss. I think this is more of a fleeting push up on these events going on in the Middle East, and that we're going to pull back a little bit here.
Okay, so no need to worry right now that we're going to just add to the economic malaise here, right?
Not yet. Not yet. We are not there yet.
All right, give me your top stock pick of the week.
It is a play on the energy market. Surprise, surprise. A more secure, stable, and less riskier play on the energy market called Enterprise Products, ticker EPD. It's a partnership. It has major infrastructure assets in the Gulf Coast. It's one of the largest. They pay a good dividend, currently yielding in the 5.5% to 6% range. They recently purchased another major partnership with which they had a relationship. I think overall a very good stock to own in the current environment.
All right, Kevin.
By the way, I do think oil is going up, but
Yep.
I don't think it's
We
going to
gotta
kill the
move.
economy.
We
It's
gotta
not going to
move.
kill the
Top
economy.
stock pick.
UNH is my pick. They are a healthcare company. They provide services worldwide. What I particularly like about them is they have tiny, tiny valuations. Price to sales of 0.5. They have a price to book of 1.82. Tiny price to cash flow. I think that the price target is $55. It's a big move from here.
Trace Nader.
I'm doing oil as well, but my stock pick is Cimarex Energy, a little different than Shiraz. His was more conservative. Mine is the Explorer play. Shares are at all-time high, but it's not super expensive here with a PE of about 16. They did just raise their dividend, but you're not really buying it for the dividend. And they get most of their oil out of the Permian Basin, which is New Mexico and Texas.
Okay. Well, we appreciate you being here with us. Thank you for your time. Hope the week ahead is a profitable one for you, and we'll see you next time here on Profit from the Pros.